Welcome to the InterMarket Analysis video update. This is a video that I do once a week where we look outside of the S&P 500 to look at other sectors within the stock market, to look at other indexes. We also look at other markets. We look at the bond market. We look at the commodities market. We look at the currency markets just to get some insight as to what's happening, because no market exists in a vacuum. No stock, no index, no sector operates all by itself without necessarily impacting the larger market. And sometimes what we see happening in a different market can play a role in what happens in the stock market or in the S&P 500. This is being prepared for Tuesday, January 16th. The first area that we look at is just within the S&P 500 mostly, where we look at valuation. Stocks have to justify their current prices. They justify that based on earnings, and that's ultimately what impacts a stock's price. If a company is earning more and having more profits, their stock goes up. If they're earning less and having less profits or starting to see losses, that will have their stock go down. Well, over a period of time, the market has come up with different ways of being able to measure this. And one way is to look backwards by using a thing called a PE ratio, or price to earnings ratio. When that gets really high, that means price is overriding the rise in earnings. When that gets low, that means earnings are overriding how price has been behaving. And we can put this on different static scales of anywhere from 20, 15, or 10. So the first area that we look at is just the S&P 500. Now, this looks backwards at a thing called the TTM, or trailing 12 months. We measure this according to static numbers of 10, 15, and 20. The red line is 20, and that's the closest line that we're to. In fact, we're actually above that. So when we're at 20 or above on a historical basis, the market is considered to be expensive. Now, we can remain expensive for a long time. You can see when the market's really going up, it's well above what the historical earnings were. And then on the bottom, I have the spread between the two, the current price of the S&P measured against the PE ratio of 20. And we can see that it's well above the zero line here. We can also look at this historically to see what big events in the stock market have happened and what the valuations were at that time. Another way to look at historical prices is to take an average over a number of different years to have things settle down a little bit. And this was developed by Robert Shiller. It's called the Shiller PE ratio. You also may know this as CAPE, C-A-P-E. The latest reading based on his calculation is 32.2. Well, to give us some perspective, we can look at a historical chart. We can also look at the median and the mean over a period of time, and we still remain between about 16 and 17 for the mean and median, and that's almost double what we're seeing right now. So this also suggests on a historical basis, stocks continue to be expensive. Then we look forward, because that's what the market does. And I have a number of charts after this to show you that's the game that is played in the market. We're not buying a stock based on what it's earning right now, even though it may react to a current earnings report. An investor will look out into the future and say, okay, this company, their earnings are what they are right now, and they should be higher at some point in the future. That's really what you're buying. You're buying future earnings at that point. And so we have a thing called the forward PE ratio, and this is posted by Y Charts, where currently we're coming in at 2209. So we're above that 20 level. So we're kind of getting expensive when we look forward with our forward-looking PE. Now, Real Investment Advice tracks these things over time, and they're saying in this chart that earnings estimates, this is looking out into the future, are well ahead of economic realities. And they post this chart every once in a while. And it's just showing how they are seeing that analysts looking forward are just getting kind of unrealistic when it comes to what they think earnings will be. Because when earnings projections as the whole go up, that justifies an index going up. Just like for an individual stock, it can justify the stock price going higher. Then we also look at, this is Deutsche Bank. And they're kind of optimistic. The purple line right here, they still are projecting that earnings are going to go up, where the consensus for the fourth quarter earnings for 2023, the consensus is this orange line where they actually have them going down. Then we look at the next 12 months or NTM, and we just see how this is continuing to go up, suggesting that earnings should still be more positive. And then here's another one. This is the real S&P 500. That means we take inflation into account. That is the blue line in here. And then we have the black line, which is the Robert Shiller or CAPE, the other chart that I showed you a minute ago. That's the black line. And this chart's a couple of days old. We're up at 32 now, where the time I found this chart, we were at 31.68. This is also suggesting that on a historical basis, stocks continue to be expensive because we go along this orange line here. This is when we're above this, that means we're expensive. When we drop below this, that means we're more inexpensive. And then looking at the valuation ranges and then comparing it with other markets in the world, where the US is getting it to the high end of the valuation range at 19.7. Usually we're in this blue area right here. And then you have the whole world. So US stocks are more expensive than world stocks as a whole. And then we have different indexes that you can follow along, showing that still here, the US continues to be more expensive than other stocks, but they're also considered to be more valuable. And then looking at the earnings per share revisions, that's what happens. An analyst will come up with their projections, and then they're constantly revising that. If they revise it higher, that tends to be positive. If they revise it lower, that's negative. And then we see, okay, as a group, are they revising higher or lower? And 2023, that's what we were seeing. That's the green line. And this was below the typical revision that we see. And it's fairly common to have an analyst come out and say, yeah, next year, things are going to be really rosy. And then as we get closer and closer to that year, they're like, well, maybe not as rosy as I thought before. Let's get a little bit more realistic with this. And so there is a slight tendency for earnings to be revised down. And so far in 2024, we're outperforming where we were at back in 2023. All right. And then globalization, it's led to higher PE ratios because I talk about the static 10, 15, 20 level for the PE ratio values. And then in the deep dive video, I go through another chart because the VIX or different fear measurements, they don't always stick to these different ranges. Well, the PE ratios can go up and down as well. And before we saw the fall of the Berlin Wall, we tended to have a lower PE ratio when you look at all of the different stocks. After the fall of the Berlin Wall, which also included the fall of the Soviet Union and a lot of changes that went in the world in the late 80s, early 90s, the markets have gone to accepting a higher PE ratio, and we're even getting above that right now, but we could go higher based on other valuations that we've been through in the past. Then another area that we look at is growth versus value. When you want to buy low and sell high, that's growth. When you get into a stock because it's paying dividends, or maybe it holds up better during market declines, or there's something in the company that you consider to have great value, that's more value investing. Instead of the hope of a future, you're buying what that company, their track record, what they already have done, and dividends that they've already paid. And we can compare these two. We look at growth versus value. First of all, though, we just look at growth, and this is an index, and it has been bouncing back up, and we are in an uptrend when we look at this pure growth index. We're also in an uptrend when we look at the pure value index, where it's been coming down recently over the past week or so in 2024, but it's still in a longer-term uptrend. How this can be helpful is when we take ratios between the two. We do the growth to value ratio. And if you watch the daily videos, I go over this all the time. I really pay attention to this. When growth is outperforming value, that tends to be more positive for the market. When value is outperforming growth, that tends to be more negative. And we have been in a longer term uptrend, but growth had really been falling back. But over the last week or so, we've been seeing an improvement. We're getting ready to see a potential death cross here with this ratio. Can we get up above this and possibly either negate that death cross or have it be a very short-term death cross? That would be more positive for the market. Then on the bottom is an inverse of that same ratio where we're taking value to growth. And the reason why I have multiple charts here is you can see the crossover with these moving averages. They didn't appear exactly at the same time. They're calculated a little bit differently. Inverse charts are a little bit different than regular looking charts. And so we just want to see confirmation where value has been underperforming growth, but then it started to really come back up, but lately has been seeing some weakness. Then we take a number of different growth to value ratios. We look at some growth ETFs versus value ETFs, and we have been coming down, and we're getting really close to a death cross here with the blue line crossing below the red line. If we can bounce back up off of this, we might see an improvement with the moving averages. Here's an inverse of that same chart showing how value has been bouncing back up, but then coming back down recently. Here's another look at the same peer growth to peer value index study where this is actually in a downtrend. And we're wondering, is this going to show some improvement or continue to decline? So we're getting a bit of mixed signals here. This is also looking at value to growth at a shorter term time frame where value had been really starting to go up and now it's beginning to come back down. Then we look at some other indexes here where we're seeing recent weakness with growth, but some improvement just over the last week. Then we look at a different measure. This is growth to value, where this is still holding up okay. We're coming up to the upper side of this rainbow, and this is showing some improvement after it had been declining. Here's an inverse showing where value had been bouncing back up and is now starting to go back down. So we're seeing a little bit of a mixed picture when we look at growth to value. We want to see growth really doing well. That's why I really cover this in the daily videos. And because cyclicals, these are stocks or companies, when the economy's doing well, those stocks do well. When the economy's under pressure, those stocks tend to underperform or actually decline versus defensive. These are things that they don't really participate to the upside when the stock market's going up, but they don't participate as much to the downside when the stock market's going down. So we call them defensives. These are things that people still have to have in their lives, no matter what's happening in the economy. And what we've been seeing back in 2023 in the fall, when the market was starting to go up, we saw cyclicals really outperforming. And then towards the latter part of the year, we saw this really falling off. When this is going down, that means defensives are outperforming. This includes staples and different value type investments. And for this to turn and go back up would be more positive for the market to have the cyclicals outperforming. Then we look at the small caps, and I've been saying this every day in the daily video. We're pretty much chopping sideways here. We're still in a longer term uptrend when we compare small cap growth to small cap value. We did see a little bit of a bounce up recently after getting off to a rough start in 2024, but we're just about in the middle part of this sideways range. What's been holding up a little bit better is mid-cap growth to mid-cap value. That's more at the higher end of its range and in a more solid uptrend. Then we look at, and this is what I focus on the most here, the S&P 500 growth to value ratio, where it actually was declining as the S&P was going up. That was a negative divergence that we were seeing. But lately, just over the last week, we've been seeing this rebound. We wonder, can that continue? We want to see this really going up to help turn the index more positive. In fact, we were going down so much, we've seen a recent death cross with this ratio. Then we also keep an eye on inflation. Here's a monthly chart of the CRB index, which measures commodities, and it continues to be underneath its moving average as we've been seeing the CRB index itself going down. And then on the bottom, we have an inflation to deflation ratio. When this is going down, that means deflation is outperforming inflation. When this is going up, that means inflation is outperforming deflation. And that's probably a good thing. We all like the idea that prices could go down. We just don't want the deflation to get going too fast because that could even actually be worse than inflation in the bigger picture when you look at the economy. Just think of the Great Depression that took out the 1930s across the world and in the US. Then here's the CRB index where it had been doing better. Now we're showing some weakness and we've just started to generate a death cross with the CRB index. Here's the Baltic Dry Index. When this is really going up, that means it costs more to ship goods. When this is coming down, that means it costs less, but we're still in a longer term uptrend. Some other markets that we just keep an eye on here. Here's aluminum. It has been bouncing up, but it's still in a longer term downtrend. Corn continues to be in a downtrend. Wheat has been bouncing up, but then coming back down. It's still in a downtrend. Fertilizer starting to come back up, and it's pretty much been going sideways, but longer term, it's still in a downtrend. Oil, this impacts us every time we want to fill up our car. It's been chopping around. It spiked up when things broke out in Israel and then since has been coming back down. It actually declined a little bit this week because there's been some announcements out of the Middle East that they're actually going to not produce as much. Then we also look at the oil price and compare it with different things that have happened. And we see here when it really spiked up, that was when the Russia-Ukraine war started, and then we started to come back down. This spike up that you're seeing here, that's when things started to go more warlike in Israel with everything that's going on there. And that's why we keep an eye on oil, because oil going up can be positive for the stock market. But if it's going up for geopolitical reasons, it can also be inflationary, and that can put some pressure on the stock market. So that's why we just want to keep an eye on this. Here's gas, which is still in a downtrend, which we probably all welcome because we want to pay lower gas prices. Here's diesel, which continues to also be in a downtrend. That means it's costing less for trains and 18-wheelers to ship products all over. Here's heating oil, which continues to be in a downtrend. Natural gas started to go back up, and it could be getting ready to see an uptrend here, but it's still in a longer-term downtrend. Copper, it's kind of mixed up right now. The moving averages, at least in some charts that we look at, we're really having a difficult time here because we start to go into an uptrend and then we see weaker than expected economic data, and then that pushes copper down because copper tends to do better when the economy is looking better moving forward. It tends to go down when the economy is looking weaker. And as the market's trying to figure out what's going to happen and what's going to happen with interest rates, copper has been caught in a bit of a crossfire. Then we look at the copper to gold ratio. When this is going down, that means that copper is underperforming gold. Here's a longer term look at that same chart. That's the black line, which overall it has been declining, showing that copper's been underperforming. We also plot the 10-year yield and the 2-year yield here, and these are still far apart from each other, and they tend to move in the same basic direction. Although for the last year to 2 years, they've been really far apart from each other, and sometimes they even move in opposite directions. Looking at the gold ETF, it still is in a longer-term uptrend, but it's really not breaking out above previous highs. Silver is in a downtrend. We still see where the blue moving average is below the red moving average, and it's pretty much chopping sideways. And then we look at the closing value for gold on top and the closing value for silver on the bottom. And you probably know this intuitively, but the gold to silver correlation, meaning if gold's going up, silver's going up, and vice versa, yeah, the correlation is still pretty strong between the two. Then we take another study. We look at the gold to silver ratio on top, and then we plot the US dollar index here, and they're having kind of a tendency to go in the same direction. We want to see this relationship more stronger than what we're seeing right now for us to really get anything from this chart. Then this is people that are investment advisors putting their folks into gold. When this is going up, that means that folks are just getting more and more into gold. And you have a lot of the perma bears out there that no matter what happens to the price of gold, they can always rationalize and justify it. And gold, there's a place for gold, but at the same time, they've been touting that this is where everybody should be. And a lot of people have lost a lot of money by listening to that. Here's the dollar index, which now we're finally starting to see on the daily chart the beginning of a death cross with the dollar index. When we compare it to the euro and the Japanese yen, I have individual charts here. The euro is now generating a golden cross against the dollar, but the Japanese yen is still in a downtrend when compared to the dollar. The British pound is starting to resume an uptrend compared to the US dollar. Then looking at some index ratios, and I show this in every daily video, where recently we've been seeing a lot of improvement with the equal weight S&P. That's where you take all the stocks in the S&P 500 and they're all treated equally. Whereas the S&P 500 index is a weighted index, so the bigger companies have more of an impact. When the red line is going up and actually outperforming the black bar chart here, which is the weighted S&P, that means that we're seeing more broad participation. Now, the S&P can still go up like it did in 2023, with the rest of the market underperforming. That's when we see the big magnificent 7 or the great 8 or the big mega caps that end up outperforming, and they're such a huge part of the overall index valuation. Then we look at a ratio between the S&P 500 and the CRB index. So we're looking at stocks versus commodities. where stocks are now starting to outperform commodities. Here's an inverse showing how commodities are underperforming stocks. Here's the NASDAQ 100 and the S&P 500. Both have been doing really well the last year or so, but the NASDAQ 100 has been doing even better. Then we look at the S&P 100 versus the S&P 500. This was producing a little bit of a concern as the 100 big stocks were starting to underperform the rest of the S&P. We could be seeing an improvement now, but we're still in a longer-term downtrend with this ratio. The NASDAQ and the S&P 500 both have had pretty good years this last year, but the NASDAQ has been doing even better compared to the S&P. The NASDAQ 100 has been even outperforming the NASDAQ itself, and a lot of that is due to the mega caps outperforming. Then we look at mega cap growth versus the equal weight index, and this still shows that as this has been going down, even though we saw a little bit of weakness in the market, this just means that there's more broad participation in the market with stocks going higher. But now we're starting to see this turn back up, and it's still in a longer-term uptrend. Then we look at the ratio between small caps and the S&P. Small caps, we wonder if the January effect is already come and gone now, or if it still has some legs left. This was really going up when we compare the small caps to the S&P, but lately, over the last week, it's been really starting to come down. The blue line here is the S&P. In a more solid environment, we want to see the red ratio going up and the blue line going up. Then we look at another ratio between the small caps where they were starting to bounce back up. Now, over the last week or so, they've been starting to underperform. And we pretty much have seen that so far for 2024. Then here just looks at valuations for small caps, and it says low current valuations. And this is looking at their past valuations, which are right around, well, we can see right now at about 15% here. But if you look at forward valuations, they're even cheaper right now. And so a lot of people are going, maybe I should start getting into small caps because their valuations, even on a historical basis, where the S&P is considered expensive, we have the small caps that are considered to be fairly priced or even inexpensive. And this may entice some folks to get into some small caps. When we look at the 30 biggest software companies, it looked like they were really starting to show an improvement, and we could be getting ready to see a golden cross here, but we haven't quite seen that yet. Here's the mega caps. These have been the real leaders taking the market higher. And the robotics and AI ETF is showing some improvement. It's also showing a little bit of improvement when we compare it to the tech sector. Here's the Dow Jones Composite Average, which is the Dow, the transports, and the utilities. This is assuming more of an uptrend now. The Dow's been chopping more or less sideways, and utilities have been under pressure, and the transports have been underperforming the Dow. So even though we're seeing more of an uptrend being developed here, we've been chopping sideways for the beginning of 2024. When we look at the S&P and compare it to shorter-term bonds, it still shows that stocks are outperforming short-term bonds. We take a broad market look and look at further out bonds. Stocks are still outperforming there as well. Low volatility stocks. These are the stocks that held up better in 2022 when the market was under pressure. Is something being flagged here? Because we've been seeing a real improvement in the low volatility stocks, enough to turn this over to an uptrend. Is that something to be concerned about? If the market was really, really going higher, we would see the low volatility stocks going down because folks like to get into the high beta stocks. The fact that this has been going up, just something to be aware of. And we look at a ratio between the low volatility stocks and the S&P, they're clearly underperforming. So if you guys are getting into low volatility stocks or this low volatility ETF, it's really underperforming the S&P. You would have outperformed by just getting in an S&P 500 mutual fund or the SPY ETF. We look at the tech sector and compare it with bonds, showing how tech is outperforming. And then we look at some other stocks. This is an advanced decline line studies, and I've been showing this in every daily video. We just want to see across the board what's happening in different markets. Where the NYSE common stock, it has been declining. We're holding up a little better with the S&P. That's because of the mega caps. We're seeing a little bit of a decline with the mid caps, and we're seeing more of a decline with the small caps. So we're seeing a bit of a negative divergence here. We want to see those small caps and the mid caps turn back up. That would probably help the S&P 500 to turn back up as well as the NYSE common stock. And then this is another negative divergence that I've been watching for some time. The Dow is just within a stone's throw, if even closer than that, of its all-time high. But the transports, they can't even get past this previous high. That is a negative divergence. When this was really going up, this was helping the Dow and the S&P to go a lot higher. And the fact that this is underperforming is a little bit of a concern. And right now we're just seeing it as a negative divergence. Here we can look at a ratio between the transports and the S&P. When this is going down, that means the transports are underperforming, and that is a concern. We look at the Dow to transports ratio, and when this is going up, that means the Dow is outperforming. And the relationship between the S&P and the S&P had a good week last week, where the transports, So we're seeing this relationship really start to go down and not be as strong. We look at a thing called new Dow theory, where instead of using the Dow, we use the S&P 500 on top. Instead of using the transports, we use the NASDAQ, which is tech, instead of the transport stocks that are a bit archaic in some people's thinking. And mainly here, we do see a little bit of a divergence where we're getting back close to the all-time high with the S&P, where we're a little bit underneath that with the NASDAQ. So this is something that we're going to keep an eye on. The FANG index is really near its all-time high and still holding up fairly well. Longer term, we're really close to that all-time high. The reason I have this chart is if we start to fall, we'll be looking at some of these other levels as possible support. And then the Magnificent Seven, this is the market cap of the S&P. When we were really getting high here and the market was going up, it was 30% of the capitalization. So yeah, the big seven stocks, they do have a real impact on the market. ARK didn't do all that great this past week. It's still in a longer-term uptrend, but after seeing a nice bounce in 2023, it's pretty much been declining so far in 2024. Then this is a monthly chart of the S&P with a ratio of another global index, stocks that are in Europe, Australia, Asia, and the Far East. When we're above this red line and advancing, that means that the S&P is outperforming global stocks. We can also measure that with a PPO, or percentage price oscillator. And even though this is above zero, it is starting to roll over a little bit. So we'll be keeping an eye on that. But this is a long-term chart since it's a monthly chart. We look at bonds based on price. They're showing some improvement, and we're seeing the total bond ETF start to get into a new uptrend. And world bonds are just getting to the point now of seeing a golden cross here. So that's showing some improvement. The stock to bond ratio on a monthly chart shows that stocks are outperforming. A shorter term look shows the bonds are underperforming stocks. And we're looking at high yield corporate bonds. These are junk bonds, and they continue to do quite well right now. And when we look at investment grade bonds, these are corporate bonds, more conservative bonds. They're also showing some real improvement. And when we compare a ratio of riskier bonds to more conservative bonds, we're pretty much going sideways now, with folks still tending to prefer the riskier bonds over the more conservative bonds because they get a higher yield with the riskier bonds, and they're willing to assume that risk. Now, if interest rates really start to come down, and if the Fed really does start to come in and cut interest rates, we'll probably see this ratio decline because people can lock in further out rates or yields because interest rates are going to be falling, and then they would tend to get out of the riskier bonds and start to get more into the conservative bonds. Here's a stock to bond correlation where it's coming down a little bit, but they're still having a pretty strong tendency to go in the same direction at the same time. Here's the corporate bond index showing that we're in an uptrend, so that is looking better as well. Here's the 10-year yield where it had started to go up at the end of 2023 and beginning of 2024. Now we're seeing yields coming back down. Here's a longer term look where we were wondering, are we shifting into a new environment here? Because we have been seeing a real decline over a 40-year period of the 10-year yield, and now it was breaking out above that. And it looked like, okay, maybe we're going to get into a higher interest rate environment. But now that seems to be in question because we've been seeing the 10-year yield really starting to come back down. And then this is the change over 44 business days. The point that I want to make here, and I did show this in one of the daily videos, is from October to the end of the year, we saw a massive decline. We were up at 5% for the yield on the 10-year, and it just came down up under 4%. And to see it move that far, that fast, that's what's being measured here over on the right-hand side. Well, what has happened other times when something like that has occurred? Well, we ended up having the Euro crisis. That wasn't positive for the market. This is before we had The COVID crash, that wasn't positive. Is this time different, or is this giving us some kind of a clue that something is happening? We are seeing some different anomalies in the market right now. We have 1-month yields higher than 3-month yields. We have an inverted yield curve, but that's been going on for a couple of years. We're seeing where yields are coming down really fast. Now, it could be positive for the market, but at the same time, we just want to keep our ear open and we want to keep watching the charts just in case the market is telegraphing that some problem is on the way. We don't know that right now. It's a pure guess. Everybody can speculate. You can watch all the YouTube videos you want. People are going to have the answer, say it's this, that, whatever. We just look at the charts, and all we can do with is go with what we see for right now and just be aware of these things. Here's the 30-year yield, which after really going up has also been coming down. It did start to go back up, but we're currently at 4.2%. And then this is the S&P 500 on a ratio basis with the 10-year yield, showing how the S&P is outperforming. Then here's the junk bond ETF, which continues to hold up quite well and is in a solid uptrend. Here's the junk bond to more conservative bond ratio, where it had been starting to come back, and we're wondering, okay, as interest rates are going down, maybe folks aren't as enticed to get into junk bonds. They want to get into the more conservative government bonds, but lately we've been seeing this start to go back up. And then here's just an ETF of the 7 to 10-year bond reading on here, where with the RSI, we're above 50. We're just getting ready to see a golden cross based on trend, but the momentum so far in 2024 has been down. And then we look at a daily chart of all the yields where we, for the most part, have been declining. This is that real big move down that I showed you on that earlier chart that we saw from the end of October into the end of 2023. Here's a weekly chart looking internationally where the US, UK, and German rates have been bouncing back up recently. We're still seeing the Japanese rates continue to decline. The MOVE index measures the volatility of bonds. The VIX measures the volatility of stocks. And we're seeing that their correlation between the two is fairly strong right now. Not really sure that's really helping us, but we just want to know what's happening there. And then here's a monthly chart of the 30-year based on price, where it's continuing to be in a downtrend, even though it has been bouncing back up. When we do a ratio between the long-term bond price and the CRB index, bonds are still outperforming. Even though the CRB index did well in 2023 for a while, it wasn't enough to change the long-term trend based on this chart. Then looking at different sectors, where we compare the 11 sectors in the S&P to the performance of the S&P itself, where the materials sector is underperforming, communication is outperforming. That's been a stronger area. Energy continues to underperform. Financials were showing a lot of improvement, but then the banks came out with their earnings on Friday, and the market really didn't like that all that much. So we're seeing this ratio coming back down. Industrials continue to underperform the S&P, even though there was an improvement. Lately, we've been seeing some weakness. Tech continues to be one of the stronger areas in the S&P. Staples is underperforming the S&P. Real estate, this was when we were seeing interest rates going down. That really helps real estate. Well, lately, we've been seeing some more weakness here. Utilities continue to be under pressure compared to the S&P. Here's the S&P to utilities ratio. When this ratio is going up, that means the S&P is outperforming utilities. When this is going down, that means utilities are outperforming. And typically when this ratio is going up, the S&P is going up as well. Here's healthcare, which is more defensive, since you have to have healthcare no matter what's happening economically, but it continues to underperform the S&P. Here's another chart showing that it's in a longer-term downtrend. Here's discretionary to the S&P, and this was an area that for about half of 2023 was doing really well. Now it's just not doing all that great, and in fact, it's really starting to fall down. It's in a longer-term uptrend, but see how this ratio has really been falling off lately. The staples sector, which should be going down if we're improving economically, has been going up. And you can see it's in a pretty established uptrend here. We're not quite there yet to see a golden cross. We look at the tech sector, which continues to be in an uptrend. Here's the semiconductors, also in an uptrend. The tech to S&P 500 shows that tech is outperforming. Here's energy, which has been underperforming the tech sector, so that's why we're seeing this ratio going down. Growth stocks compared to bonds, more conservative bonds, and it just shows how stocks are outperforming bonds. And the tech sector to the rise in the 10-year yield shows that the tech sector is outperforming. Here's an inverse showing how the 10-year yield has been underperforming the rise in the tech sector. And this is discretionary to staples. This is another growth to value type measure where discretionary still, it's all right, but it's just not doing all that great. We want to see this really outperform. It's still in a longer term uptrend, but we're seeing some weakness so far in 2024. Here's an inverse showing how staples are underperforming discretionary. And then we look at gold and do a ratio to the S&P where the S&P has been doing better. And then we compare gold to the dollar. Well, as the dollar's been under pressure, we've been seeing gold perform a bit better. Then we look at high leverage loans, which continue to be in a solid uptrend. And here's the NYSE composite. This is a broader market measure that we look at. It's also in an uptrend. All stocks, look at US stocks as well as world stocks, also in an uptrend. Emerging markets are starting to show some improvement. They've been chopping around lately. We're just starting to generate a golden cross here. And I have a couple extra charts. This is a ratio of emerging markets against US stocks. And the ratio is really going down. And you can see we're getting down to this -1 standard deviation, where sometimes that has marked the bottom. And so a year ago, everybody was the rage was for about the month of January, getting into emerging markets because the dollar had been really moving and it just looked like stocks outside of the US were looking more attractive. And by the beginning of February, that kind of faded and went away and never really turned into anything. And we're wondering, is something like that going to develop? We don't really know right now, just want to be aware of what's happening here. And then this is a further breakdown of some of the different world indexes. You have Mexico, India, Turkey, Indonesia, Brazil, and then the red line is the US. There are ETFs for these countries if you want to participate on an international level. This just kind of gives you an idea of how they've been performing. And then we look at the Bank of America. They seem to be real bullish on Japan right now. They think we're going to go back and go above the 1989 high here. We don't know if that's what's going to happen, but that's what Bank of America is at least predicting. And then here are the microcaps. These are really small companies. They have been showing a lot of improvement lately, enough to generate a golden cross. Then we look at the home builders study, where we have the S&P on top and the home builders, the ratio between the two, and we still have a pretty strong correlated relationship. When we focus on this is when we see these readings getting really low in these yellow areas here, and we're just not seeing that right now. Bitcoin, where there was an announcement over the last week that there's 11 ETFs now that you could get into Bitcoin on the spot price, which means their cash price right now, not futures, not looking out down the road. And that helped Bitcoin do better earlier in the week. We almost got up to the 50,000 mark, and lately it's now been dropping back down, but it's still in an uptrend. So when we look internationally, we're rolling over a bit in China. We're actually declining with the emerging markets now. We're turning up in Europe. We're declining in Japan, and we're still declining in the US. But this is the KST. It's a longer term oscillator, so it takes more for this to turn and go in the other direction. Then so far in 2024, here's our intermarket analysis chart. We have oil doing the best, followed by the dollar stocks, where gold is negative and the price of bonds are negative. Some different correlations. We're getting back to neutral when we look at the relationship between the S&P and the dollar. We're having a slight tendency right now for the price of oil and the S&P to go in opposite directions. And then we look at the S&P to the 10-year yield. They're neutral when you look at them and compare them with each other. We're also coming back to neutral when we look at the tech sector and compare it with the 10-year yield. And we're still having a slight tendency for the S&P and the 2-year yield to go in opposite directions. And that's an indicator that I look at. It's part of the possible positive scenarios. When the 2-year yield is going down, that often gives short to intermediate term support to the S&P, and that's what we watch for. And then our long-term secular, which can be decades, and cyclical trend studies. Cyclical could be years. This is a monthly chart of the NYSE. We're above this longer-term moving average. That's positive. And the Copic curve, that's a momentum oscillator, continues to be positive. Here's a daily chart of the NYSE, and we're showing the NYSE record high percent index continue to advance. That's positive. Then we look at the S&P on a monthly chart, and we're above the moving average, so that's longer term positive. And the PPO here continues to be positive as well. So longer term, we're looking okay. And then we look at the ratio between the S&P and the CRB index, where stocks continue to outperform. And then we look at the S&P and look at another global index where we're above the red line here with the ratio. But the KST, it's taking a long time here. You'd think we would start to turn up, and it just hasn't begun to do that yet. Then at the very end of this video, I look at all the things that are positive and make a list, and all the things that are negative and make a list. My definition of positive is when the 50-period moving average is above the 200-period moving average. We have the growth indexes. Now, some of the ETFs are starting to look more negative, but the growth indexes themselves are looking better, as are the value indexes. The British pound and the euro, they're starting to be in uptrends against the dollar. Gold is still in an uptrend. The mega caps, the FANG index, ARK, the low volatility ETF, which is kind of strange. We're wondering if that's a warning sign. The Dow Jones Composite Average, that's the Dow, the transports, and the utilities together. And then we look at bonds. They're showing a lot of improvement based on price. The total bond ETF, the high yield, which are junk bonds, investment grade bonds, more like corporate and government bonds. Also, the corporate bond index is looking better, junk bonds as well as world bonds. The tech sector and semiconductors are in uptrends, high leverage loans, the Dow, the NYSE, the NASDAQ and NASDAQ 100, the mid caps, small caps, and the micro caps now. All stocks, emerging markets, and Bitcoin. So we've got a lot of things that are either turning positive or remain positive. Then on the negative side, this is when the 50-period simple moving average drops below the 200-period simple moving average. The dollar is now starting to see a downtrend. The CRB index, silver is still in a downtrend. Copper, that's because the moving averages are right on top of each other right now. So we're kind of undecided about copper currently. The Japanese yen is still underperforming the US dollar. And then the big software companies are in a downtrend. The staples sector, there, I'll go back. The staples sector, all right. Then that shows that I am finished looking at all the different charts here. Thank you. I hope you found this helpful. I hope you have a really good weekend. Please feel free to check out the daily video. There's the weekly video. After this, I'm going to do the deep dive video. I hope you have a nice holiday weekend, and I will talk to you in the next video.